welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As investors, we Indians have understood the power of equity and, of course, equity mutual funds over the years. We've seen the wealth effect at play. So while we rush to buy the dips in the market, the question I'm asking today is, do we give enough thought to creating a well-balanced portfolio? Do we give enough attention to asset allocation? Markets can be volatile and life can be uncertain. Are we prepared? What should be the asset allocation and portfolio construction strategy, not for 6 months or 1 year or even 6 years, but for long periods of time as we look forward towards planning our wealth and our finances? That is what we're discussing on the show today. And helping me answer a lot of these questions, I have two guests joining me. We have Mr. DP Singh of SBI Mutual Fund and Feroze Azeez of Anand Rathi. Well, gentlemen, thank you so much for joining in. I know I'm raising some boring textbook type questions, right? Because these days investors just want to know what's the next hot fund to buy, and they want to sort of leave it there. But that's why I think we have this show, because we want to have more in-depth conversations, ask the big questions that investors need to sort of ask themselves. So thank you so much for joining in. DP sir, let me start with you. Opening thoughts. Why is it that we need to go beyond just the next hot mutual fund?
No, because see, investment is as you said, boring, but very important, very responsible thing to do, because you are investing for your future, you are investing for the next year, which is very, very uncertain. So you have to do it very, very responsibly. Don't look at it, because whosoever is looking at the hot things is likely to burn the fingers also. So don't do that. Do it in a responsible manner, and the asset allocation is the key. It's not a key, it's the key. It has to be there. So I absolutely agree with you, and that's the very good topic which you have chosen for the discussion today.
Okay, so sir is saying it as clearly as he can. It is the key to good investing. Feroze, your opening thoughts.
See, when it comes to investing, asset allocation is very critical, because that determines 90% of your fate of your money, point one. Point two, as longevity goes up of human beings, right? In India, the longevity of male Indian has gone up by 25 years from independence. Wow. So you have more number of years to live, and you will not work till the last breath. So you're going to be investing today to be able to live the same lifestyle you're living today. So it becomes even more important as longevity goes up. And thirdly, it's very important that you don't go for hot funds, like you said. Very, very important. See, you have to choose your objective. As an individual, do I want to make money or do I want to make wealth? You can get the best stock.
That's very interesting. Do I want to make money or do I want to make wealth? And what's the difference between the two?
See, to make money, you will have to take hundreds of several right decisions. Get this fund, you enter at the right time, you exit at the right time. You have to outsmart the market to make money. To make wealth, you have to out-discipline them. You can be the most disciplined person and you will create wealth. To make money, you have to outsmart people. That's a rat race which is very difficult to win. And you may get money, right? I buy the best stock. Let's assume I found a tip of a mutual fund. Let's speak of mutual funds. I buy that fund and it rose 20% in the next 1 year. Okay?
I made money. I'm happy.
I made money.
Yeah.
But if you put 1% of your wealth in it,
yeah,
that's just going to be party money for you.
Oh, if you've not thought through the whole investment.
Right? Can you put 30% of your money in a hot fund? You can't.
Yeah.
Right?
So that's I think something that we really need to think about. It's great food for thought as we start off. You know, I want to start with a very basic fundamental concept of knowing our risk appetite, our risk profile. And I don't think enough, gets discussed around this, because Mr. Singh, to be very honest, if you ask me, aap mujhse abhi puche, what's my risk profile or risk appetite? Frankly, I don't know if I have a very clear numeric scientific answer. The traditional wisdom used to be that the older you get, the lesser you invest in equities, the younger you are, you invest more in equities. But does that work anymore?
No, it's an outdated concept, honestly speaking. And taking cue from what Feroze has said, whether you are creating wealth or whether you are trying to get money. So that's not something which is true. And moreover, the risk appetite is not a static thing. It's a dynamic thing. Dynamic thing for what purpose? What is the objective? What for I am putting in money? If I am putting money for my children's capital creation and my child is 2 years old, my risk appetite is totally different. because I'm giving 16 years, 18 years, 20 years to that. But if my child is 16 years old and is going for higher education 4 years down the line, then the risk appetite for that fund has to be totally different.
Understood.
So that's something which is there. It's a dynamic thing. Don't think I'm a high risk appetite person or
exactly.
low risk
I'm a low risk person or a high risk. It's not an intrinsic thing.
This is not the funda. And second point which you said, with the age growing, actually, when I look at the data, the maximum money is being put in equities by the people who are more than 55 years of age.
Oh my God. Okay, look at that. It's turned traditional wisdom on its head, right?
Because that is the money which people have accumulated.
Yeah.
They have put in money there, and they are there. This is not only the one. As Feroze said, the longevity is going up. They are keeping it for next 10 more years. When they will need to dip into it, maybe at the age of 65 or 70. So they have 15 years. They can be high risk appetite, right? But if you go by the old style, you cannot put more than 30% in equity at the age of 60, right? So that doesn't work anymore. And second and most important part is, see, sometimes the money is legacy money, right? This is for my next generation. Why should I put it in a conservative fund? The risk appetite for that is different. Risk appetite for a fund which I need for my sustenance is totally different. So we have to understand risk appetite has to be understood clearly for the objective. And second, asset allocation is the key. How much I have to put money overall, that is a different story to talk about.
Okay, fair enough. So that's on risk. You know, Feroze, I want to club this with another thing that we've typically seen. So when we talk asset allocation, which basically means that should you be in equity, should you be in fixed income, should you be having more gold in the portfolio, along with, you know, the risk appetite part of it, another thing that comes into play is what is the market doing right now? So if gold has moved up 20%, suddenly you'll hear people talking about, "Arey, mera gold allocation kam hai. Maybe I should, you know, put little bit on gold." It's just human behavior and human psyche, right? How do we avoid it? What is the right approach? Risk and also looking at market movement, volatility. Should we ignore it totally? But then we're humans at the end of the day.
No, you can't ignore it completely, nor can you embrace it completely. If you have a strategic asset allocation, stick to that allocation in spite of the decibel of the noise you hear. It is like somebody playing music, but the room is filled with 100 people who are talking. You will not hear the music. So you'll have to cut the noise to hear the music. So how do you cut the noise is the most important thing, out of which some information is going to be important to you. So asset allocation, like DP sir said, is very critical. Now, second, marrying your asset allocation with your risk appetite is a puzzle to solve. Most have not been able to solve, right? If I asked a client, what's the risk appetite? He is not or she is not able to articulate to me, and they're only using English words, saying that high risk appetite, low risk, medium risk. So to be able to marry the asset allocation with your risk appetite, you will have to make sure that you understand what are the types of risk which will impact which money of yours. I can't agree more with what DP sir said. In fact, that was food for thought for me. We classify ourselves as high risk, low risk, medium risk. Everybody with high risk can have some money in low risk. And somebody in the low risk category will have to have some money in a high risk portfolio if it is for his retirement or her retirement. So to answer your pointed question, I personally think that you should definitely try and marry your asset allocation with the risk appetite, and that's going to be critical. If you see some asset which has done very well over the last 1 year, you will always be tempted. See, I remember having done a show with you in 2017, 1st January, 2017 or 18. The largest portion of question was, can we not have crypto in our portfolio?
Because cryptos were the new hot thing in
absolutely.
town.
And I think the viewer also asked why. Because that's called recency bias. That is a very important bias which we all as investors have to fight. We will be influenced by what happened in the last 1 year. That bias is called a recency bias.
Very important. And I guess going above and beyond those biases is the first stepping stone to have a disciplined, statistical, mathematical, planned way of having a proper asset allocation in the portfolio. We want to take some viewer questions as well, because we've got some queries on these lines. Subhashish Day has written in this question. This is a query we got in from Twitter. So keep sending those questions. We're, available on social media. Now, Subhashish is saying that, can you suggest some mutual funds for me which would have a low to moderate risk? I'm a beginner. I'm just starting out my journey. So therefore, I'm looking at moderate risk. This actually plays into what you gentlemen just said, that it's not like my blood group, that it's O positive or A or B minus, right? But the tendency seems to be that I'm a conservative investor, I'm a low risk investor, even though I might be a young person. So I need low risk funds. DP sir, what would your answer be, and what should the approach be for someone like Surabhi?
Again, coming back, is the asset allocation, especially when he is starting his journey of investment. He should not do anything which he runs away from the market for a longer period. That's what we have seen in the past. People who are coming in the highest risk category when they are starting their journey and their longevity is less, they burn their fingers and don't come back to the market for a decade. The next generation comes and they enter into market. We don't want. So asset allocation through mutual fund tools, there are different categories of funds. There's a category which is called multi-asset allocation fund, which puts money in equity, which puts money in debt, which puts money in the gold or silver. So those are the categories which are there, and where the personal biases go away.
Sure.
Because fund manager is not supposed to listen to the noises in the market. He has to be disciplined. He will remain disciplined, and incidentally, I will call it incidentally underlined, these are tax efficient. Because tax efficiency should not be the reason for putting money there, but incidentally it is there. So your tax efficiency is better. Multi-asset allocation, I think, for a beginner is the best choice.
So factors to keep in mind, Feroze, when you're looking at asset allocation, what are the most critical things that you should ask yourself, that you should evaluate before deciding debt, equity, gold, what you need?
So there's several factors, but I'll stick to only one factor to drive home the message. It's time. Okay, and generally a goal with longer periods of time should have equity. Why? Because there's not just market risk. Market ki utar chadav is what takes away mind share of an investor. But there's another risk, which is inflation risk, right? So that risk becomes a far more overpowering risk. If you had 100 rupees, okay, now whatever you could buy in 1980 with 100 rupees, today you need 4,800 rupees to buy the same commodity. Now you may be very happy that my 100 rupees has become 500 rupees in a fixed deposit. But if you take your 500 rupees to go buy that commodity, you don't get it. So time period is the most important variable, I personally think.
So we'll take a break on that note, but we continue this conversation on the other side. We also have lots of other viewer questions on this and how we should approach different types of fund categories that will help us achieve a better asset allocation. Back with that in just a bit.
Let's talk money